Well, the assumption here is that the Chinese economy functions like a normal free market economy, which, especially in the case of macroeconomic instruments like this, it does not. The first difference is that a lot of people and institutions with a lot of money in China can't go and buy US Treasury bonds. China has strict capital controls on money leaving the country, which means even if investors did want to buy US bonds instead, this isn't going to be an option for them. This applies even to large institutions like banks, which, it's worth noting, are largely state-owned as well. So yeah, when the Chinese government wants to borrow money, it doesn't need to compete with every other country in the world also trying to borrow money as well. The other thing is that there aren't many other options like there are outside of China. When bond yields are low in a regular economy like, say, the USA, it motivates investors to move their money into other assets like stocks, real estate, or alternatives where they can get a better return. This is one of the reasons why normally lower interest rates will increase stock prices. But in China, investors don't really have those same options. Economists will always say that the stock market is not the economy, and normally that's used to explain why market returns consistently outpace overall economic growth, but in China, it's the opposite. Despite being home to the most intense economic development in history, the country's stock market is up less than 100% since the year 2000. Now that might not sound so bad, but by comparison, the US market has returned over 300%. And it's not like we've chosen an unflattering timescale here. In the last decade alone, the US market is up more than 150%, while China's has actually gone backwards. That means that the stock market is not exactly a great alternative to even really low yield bonds.